Thank you, Jeannie, for spending your time today to discuss third-party risk management. Can you start by providing a brief background of yourself?
Thank you for having me, Dustin. I am, however, only one of many very talented senior directors at A&M specializing in strategic sourcing, supply chain management, and third-party risk management. By way of my background, I've been with A&M 4 years this month, and I've been in supply chain management for a little over 25 years. I started my career with the US Army, serving 8 years in the Quartermaster Corp. I spent my career post-military primarily in industry for global organizations such as GE, Bank of America, Wachovia, which is now Wells Fargo, and NBCUniversal. My functional experience in supply chain management includes indirect goods and services, manufacturing, supply chain training, organizational development, and third-party risk management. I am certified as a Six Sigma Lean Black Belt and a third-party risk program manager.
Thank you. My first question is, why are you so passionate about third-party risk management? And can you talk about what it is and how it impacts? What are the impacts?
Third-party risk management is about managing the risk inherently introduced through utilizing the services of a third party or outsourcing to a third party. So for point of reference, a third party, as identified by the OCC, is any business arrangement between a bank and another entity by contract or otherwise. And this is mostly identified in the industry as a vendor, supplier, a counterparty or joint venture, or even a parent and subsidiary, to name a few. This also includes management of risk introduced by a third party or their third parties, sometimes referred to as subcontractors or fourth parties. As the practice of utilizing third parties for core business practices have grown over the years, so has the risk of failed performance, data and information breaches, and bad business practices. While businesses can outsource services to a third party, and they do, they cannot outsource the risk. Not only is the management of third parties a regulatory mandate, it is also a business imperative. Third-party risk management impacts not only the company contracting for the goods and services, but it also impacts the employees, stakeholders, suppliers, and customers, as these are key stakeholders in the continuance of a business. I think my passion around third-party risk management is due to its close alignment and integration with supply management and supply chain management. Due to the evolving threat landscape, regulators and companies are struggling to keep current, let alone try to get ahead. And I have been leading third-party risk management program design and operations since the early 2000s with the issuance of the GLBA, the Gramm-Leach-Bliley Act, and have been privileged to help both companies and suppliers identify and mitigate risk within their supply chain. I think one of the toughest challenges that both of these entities face is the ability to build a program nimble enough to withstand the constant change that's necessary to meet the business requirements as well as the regulatory guidelines for which they are accountable.
And what do you see as the future of third-party risk management?
Continuous change, more regulatory influence, more stringent management on those third parties that are critically important to organizations, more internal and external audits of both businesses and third parties, and a better understanding of the supply chain internally and better management and hopefully a program that scales based on the services provided and the risk involved with the delivery of those services.
Can you talk about who needs to pay more attention to third-party risk management?
What we are seeing in the industry varies based on the level of maturity. Financial services, based on their history with third-party risk management regulatory oversight, show broadly the greatest level of maturity in the industry. However, where they seem to be lacking is in the ability for quick change, moving from a one-size-fits-all program to a risk-based approach, taking into consideration the services being provided by their third parties and subcontractors. An exception to the financial services maturity is in the community and mid-tier banking sectors. Prior to the OCC guidance issued in December of 2013, community banks were not necessarily called out as participants to the third-party risk management guidance, and it was therefore not necessarily a priority within their business model. The retail and insurance industries are currently feeling the impact of a less than optimum third-party risk management programs, and these industries have the opportunity to learn from the financial services industry and reduce the learning curve by looking at lessons learned from previous failed programs and also by seeking guidance from those that have kind of been there and done that to keep from experiencing the same results. So from the perspective of who needs to pay more attention, it's the market as a whole. The threat landscape is continuously evolving, and businesses cannot afford to take their eyes off the prize of protecting their interest. As the threat landscape evolves, the market and programs that they implement must evolve as well.
And thanks, Jeannie, for sharing today.
Thank you for having me, Dustin.